guys, welcome back to another Capital Mindset Show episode. And today we're going to be doing another subscriber request. This one is a retailer known as Buckle. So the thing about Buckle, it's a smaller retail brand. And when I say smaller, it's about $1 billion in size. So it's a little bit, well, it's substantially smaller than stuff like L Brands, Lululemon, and of course, something like a giant like Nike. Now, the point of this kind of business, if we can think about it or conceptualize it as an investor, it's going to be centered around brand strength and their ability to utilize that brand and then sell to their target audience. We need to see what their target audience is, and then how are they executing on that target audience, right? So what I mean by that is if, for example, you are targeting, I don't know, youth, and then you do something and you don't adapt to the times because the youth trends change, then that's going to be difficult, right? Or if you target women and then all of a sudden you alienate the women audience, then your sales are going to suffer. So the difficulty getting into this before we really talk deeper about the business is retail tends to be pretty hard. Okay. So there are some retail giants that kind of have mastered the formula. We're thinking of LVMH, Louis Vuitton, Hennessy, some of the company that owns Gucci. So they have a portfolio of luxury brands, but they cover that niche of luxury, right? And then in the non-luxury core categories, we have stuff like L Brands that is now rebranded to Bath and Body Works. They are now just called that. They own Victoria's Secret, for example. And they're larger, but they've had to have made some adaptations over time. And for a period, they were called L Brands, but they never owned limited brands anymore. They actually sold that off, and they just owned Victoria's Secret, Bath and Body Works, and I think Pink as well. So you have other companies, for example, like American Eagle that owns a couple other new brands. So it's not, the barriers to entry aren't very steep in this category. So we got to keep that in mind going forward. Okay, that being said, let's actually take a look at the price action and see what's kind of been going on under the hood of the stock market. So let's take a look at the 5-year. So in the 5-year, we see this massive run up from the 2020 correction, and congratulations if you bought. Now the question is today, is this a compelling purchase, right? We know that it's performed well, especially out of the backdrop of the pandemic. So this tells me they probably had a good results from the pandemic. Okay, so nothing crazy hit their bottom line, and we'll actually take a look at that, see if that's the case. That's just a hunch. Let's take a look at the max. So in the max, we see a cyclical downtrend. It's very similar to what L Brands suffered when I used to look at L Brands. Very similar. So it looks like they may or may not have successfully gotten out of that turmoil, but we shall see. Again, this is very difficult business. So just so you know, from that, I'm probably going to require a higher margin of safety in a business like this. All right. So let's actually see if we can find, I think actually I want to see real quick their short interest. This is a good free website. We can see their short interest. Okay. So it's heavily shorted. Okay. So that's good to note. I don't think it would be a good short squeeze play, but that's something that could happen if the results are material. We see it does pay a dividend here, and I think we can confirm that here. Yep, the dividend. Okay, so it does pay a dividend, and we need to actually keep track and make sure that they should be paying a dividend, or do we agree with them paying that dividend? If the dividend is sustainable, those are some of the questions that brings up. Let's take a look at their website and kind of explore to see if it's good or not. I think looks good. So we see the woman, so woman clothing, jeans, shoes, accessories, men clothing, jeans. Okay. So what I'm trying to get at from here is their peripherals. So if they have to adapt to the times. And so people are looking for multiple channels in which to purchase goods and services. And so their website looks okay. It's pretty good. Nothing like wow, but it's up to snuff. It's up to the standard that I would expect. And I think there's let's see here. Right here. So this kind of is a letter written by the company, and we can see a little bit of a highlight, right? So we can see on the men's category, they were up 14.5% compared to the prior year. And then on the women's, they were up 20%. All right. So strong growth in two categories that are clearly highlighted right there, men, women, and then they have the youth category, the almighty difficult youth category. All right, with that being said, I think we can hop on over to the model and let's actually go first with the ratios. So on the ratio side there, wow, look at that. Very good. Cash ratio means they have enough cash to cover all of their liabilities. And well, their current liabilities, not all liabilities, the current liabilities. And the current ratio, of course, is going to be solid. Total debt ratio. So that's the totality of their liabilities versus their assets. So very good. A long-term debt. So it looks like they don't utilize debt as in borrowing, which is good. Gross profit margins. Okay, gross profit margins are actually pretty solid. And then net profit margins are actually decently high relative for a retail company. I want to know if they can keep that. And that's my suspicion. Will they be able to keep that? We shall see. So that's again why I need that margin of safety. I don't know if they're going to be able to keep those net margins that high. ROA seems to be really good, but again, going off of those net margins, ROE really high, going off of those net margins. But even in other years, pretty good. All right, so let's take a look at the earnings quality. Earnings quality is solid, bro. Very good. So far, nothing bad to say about this business, I got to say, just only that it's in retail. Earnings per share, free cash flow, pretty good, generating decent amounts of cash flow. Book value, we don't really care about that for this. Inventory, this is going to be very important. Okay, this sticks out. So either they're doing something amazing right now, because look at this cash conversion cycle. It's getting lower, right? So that's their ability to collect on that cash when they make that sale. That's getting lower. So either if that's sustainable, that's fantastic. If that's not sustainable, you know, that could probably be, oh, we could see that in multiple numbers, by the way, the non-sustainable of their current situation. Okay, so AR turnover. Okay, so things are getting good. This one's coming down slightly, but it's basically the same as 2020, but I don't know if they're not going to normalize. Okay, so that's, again, margin of safety. It's going to be, I'm going to ask for a decent amount, not too crazy. I'm not going to be absolutely insane about it. But on that note, I think we can go over here and start to think about what it is we're going to demand from this business. Now, they have been a little bit dilutive, slightly, and that's fine. So I see that they're not utilizing debt to fund the business. And you can kind of take a quick sniff test, by the way, as far as the market cap to enterprise value. So if you see here, the market cap is larger than the enterprise value, which is indicative that they have more cash on hand than they have debt. Okay. That's just a sniff test, right? You obviously should look into the numbers and see what's up, but they're very cheap on a PE basis and on a price to free cash flow basis, very cheap. They're growing at about modestly on average, about 5%. So let's actually assume that that's the highest rate. That's the high range. And we have to assume a discount rate, by the way. That's why it's negative. We do have to assume the discount rate. So we're going to discount it first at a 12%. This gives us a very small margin of safety. Very, very small. I would not say this is the margin of safety I'm comfortable with, but there is one there. And we can already see that even if they didn't grow, it's a fair price for that. I want to price in some decay in case I'm wrong. So let me actually play around. Okay, so if I think that they're going to actually decay in terms of sales or cash flows from here for the next 10 years by 5% each year, in that case, I can still expect a 12% annualized rate of return, which is very good. Okay, so that's fairly good. Now, let's increase this discount rate. Let's go to 15%. Okay, so at 15%, that's about 50% margin of safety on the average market rate of return. And what I can see here is if they decay about 5%, you know, I can't buy it if that's my goal. So let's actually just end up with 20 and see what happens. All right. So with 20, oh, I almost forgot to mention. Let's actually go back. So if we put a 15 in there, look what happens. We actually don't have to assume any growth. Okay. Let me just forgot to mention that before we move on. Let's go to the 20 though. All right. So on the 20, if we assume 5.8% is the high point, we're actually almost there for a zero. This is very compelling. Okay. I don't know if they're going to grow at all. So maybe it is comfortable to say at zero growth, this may be interesting as a little bit of a speculative position. Not so much speculative because they are executing. So I would not call this a speculative bet or speculative investment. Remember the distinguishment between what becomes speculative. One, is it out of your control, or sorry, out of the company's control? If it is, if whatever the investment thesis is, it has to go into the speculative bucket. All right. Two, is it execution or potential, right? Everything has a degree of potential instead of execution, but you got to be honest with yourself. How much of it is just potential? How much are they actually executing by? In this case, this business has been executing. So we have to give them that sort of credit that they may continue to execute going forward. So I wouldn't say that it's just pure potential. Okay. It is potential, right? The potential to not decay or the potential to grow slightly, but it's not pure potential, right? Something like a Zillow group, which I consider to be almost pure potential. We have to see if they can execute based on the thesis, right? Everyone has a different thesis. For example, Zillow is a speculation that they could be something accordance to the Google of real estate, right? That's the goal, right? Then if that's your thesis, what do they have to show for at the present moment? Is it potential to get there? I'd argue, yes, there's potential. Are they executing right now that they are basically on their path to that, right? Or like basically are they there almost? So the answer to me, in my opinion, would be no. So then boom, speculation. There are more potential. Okay. So what I'm trying to say with that is this company has been executing. So I wouldn't actually call it a speculation per se. Okay, so now let's actually kind of figure out what the weighting might be. And for those of you who are kind of new to the channel, this calculator over here helps me kind of determine that. It's like a flagpole. This will be out when the final software is out for use. And don't rely on it, but it is based off of the risks and the assumptions we make. It will provide us with a flagpole of allocation weighting. Okay, so let's start to think about some growth rates. So I think, for example, 5.8%, let's just round that to 6% to make it nice. And let's put a 5%. So at 5%, we're still good. Let's see 4%. Are we good at 4%? We're not good at 4%. And let's see at a 3%. Okay, so between -5, which is quite significant, and 6%, so a large difference there. We're seeing that we're basically there for 4%. We're almost there. We just need it to come down slightly, and then we're there. But we'd have to assume about 5 and above, right? Slightly above 4, so probably 4.5. Let's see 4.5. Yeah, 4.5, it's already there. So at a 4.5 or above, we're pretty much there. I think that the -5% is probably not that likely. I mean, but I do think it is within the realm of possibility, some form of decay. It's good to note that we are actually almost there still for a 3% growth rate because it's just shy at $35 would be our entry point. So what I'm getting at from this conclusion, or from my conclusion from looking at this business, is it's very cheap. Okay. My issue with it, all right, there's always an issue, is that it's in the business of retail, and business of retail is notoriously difficult. You have to adapt to the changes, and you have to be comfortable with that. And maybe you need some sort of understanding, or greater understanding than the average person, or at least myself, as to what are these changes and if the business is doing it. I, for one, know my weakness, or definitely have a weakness in fashion and understanding fashion. So for me, being involved in a business like this, I'd have to I need help consulting, and I would never myself be fully comfortable with owning this just on my understanding of fashion. Okay. So with that being said, guys, I hope this video provided you value. And if you think this provides value to someone else who's looking into this company, go ahead and share this video or any of the other videos that I do on the subscriber request series. If you guys have any other requests, go ahead and leave them down below. Remember the rules. Please no microcaps. I will usually exclude microcaps unless there is a specific lesson that I can share with the audience from them. Or if there's, some hidden gem, and then I'll look at them and be like, oh, this may be a hidden gem. Okay. As always, though, no video that I do is a form of buy recommendation or anything like that. It's simply to share my thoughts on any particular business and kind of talk about what my thoughts might be on the potential and where I would perhaps be interested in, or maybe even in businesses I might not be interested in, kind of talk about just like the numbers and stuff like that, and maybe any accounting details that may provide value to the audience. All right. If you guys have learned from this video, remember, please leave a like and go ahead and write down below a comment if something I've missed. Or by the way, I forgot to mention, I'm doing sector analysis now. So if you guys want to, the sector analysis videos will take longer. I currently have 3 on the back burner, and I'll tell you them what they are right now. So just in case you don't want to repeat them, real estate, home building, and banks. Okay, real estate, home building, and banks are the 3 sectors that are on the back burner. Each one will have their own separate video. But on that note, guys, thank you guys so much for watching and have a good one. Bye.